All right, hi everyone. Welcome to Eagle Investors. Today's video is going to be a little bit different. I thought it would be good to try and see if it would be easier for you guys to understand these if I did it off of the actual sheet so you could read along. Tell me if you like this or the slide version better at the next meeting. Anyway, today we're going to be talking about capitalization. Capitalization refers to how you get money to run your business. As you can see here, alternative terms are funding, backing, and investment. Basically, capitalization is when people give you money to start your business. Entrepreneurs, generally, they don't have a lot of money themselves. They start their own small company, but they need money in order to build their product, pay employees, pay for shipping, and they have to get it somehow. Today we're going to be talking about the different types of capitalization and the most common ones. So the most common one I think is probably self-funding. Self-funding is when the money is provided by the owners. It's also called bootstrapping. We're going to be talking about that term. It's going to be on the Kahoots and stuff. So if you remember the term bootstrapping, it comes from the phrase pull yourself up by your bootstraps or pull yourself up by the straps of your boots, which is a phrase that personally I don't really know what it means, but the term bootstrapping is what you say when you pay for it yourself. But bootstrapping can be hard to do if you're not independently wealthy. Like if you're a college student or something, college students are not exactly famed for their, great wealth, and they probably can't pay for it all themselves. Next is friends and family financing. So this is like you go to mom and dad and you ask them to help you fund your company. This one's also very common. Uh, it can be good because your mom and dad don't usually like negotiate as hard as a high-powered VC would and try to get large amounts of the company out of you. They tend to be fairly forgiving. The drawback is, of course, that now you're mixing family and personal relationships with your business, which might not sound like a big deal, and it isn't if your business goes well. But if the business folds, now, you just lost all of your parents' money, or you lost your siblings' money, or you lost your grandmother's money, or whatever it happens to be, and that can create some awkward situations. Debt financing is pretty simple. It's when you go to the bank, take out a loan, just like you would to, pay for a house. The reason a lot of people don't do debt financing is because, again, if you don't have money to begin with, the bank probably won't give you a loan to start a company. The reason is because if you're a broke college student who needs money to start their company, you have no collateral. And the bank is not going to give you a $10 million loan so you can go start your little business if you have no collateral to put up to, secure that loan. It's not worth it for them to take that risk. Banks are not generally in the big risk-taking business. Then we get to equity financing. This is what we talk about a lot at Eagle Investors. This is where you get, a venture capitalist or an angel investor, and they say, okay, I'll give you the $1 million in return for 15% of your company, 20% of your company, and that means they are now a partial owner. They hold that stock, and what they do is now they hope that your business grows in order to get a return. A lot of people really like this because now you have an investor who has an incentive to make sure that your business succeeds. What I mean by this is a lot of VCs, they have like their own independent experts that they just have who can help the companies that they invest in. You can get advice from your investors a lot of times. You can get connections from them. We talked about this more in the venture capital, introduction to venture capital lecture if you want to go back and look at that one. But basically having an investor can provide you with a lot of useful benefits in addition to money. Crowdfunding is fairly new. If you've ever bought something off of Kickstarter, that's an example of crowdfunding. Basically, the internet has enabled this where people sell an idea on the internet and people pay for a product that hasn't actually been made yet. And then if enough people pay for it, then they can actually make the product, build it, and ship it to you. So if you've ever seen those little like fidget spinners or fidget cubes, those really annoying things, I think those came out on Kickstarter. The game Exploding Kittens, it's a really fun game, kind of silly, but it came out on Kickstarter as well. There's a lot of cool stuff like that that came out on Kickstarter where people can just get funding from regular people instead of having to go to an investor or a bank. Last is grants. Grants are money given by usually the government, or it could be by a foundation. They're literally just free money, and they don't require any kind of repayment, interest, or equity in the business. Basically, this is if someone wants to support what your business is doing. A great example of this would be if you are, let's say you're a company that's doing research into a cure for cancer. You might get a grant from a foundation that, supports cancer research so that you can continue, because that foundation wants your research to succeed so you can find the cure for cancer, and they'll just give you money to do it. Uh, Things like the Department of Energy will give grants to, clean tech startups, that kind of thing. Social ventures often get grants. If you hear the term social venture, it means that it's a startup that also has a philanthropic cause. Like there was at the Rose Business Plan competition, we had one called Oze, which was a social venture, and what they did was they built basically QuickBooks, kind of an accounting thing. It's an accounting app that goes on a phone, and then their market was they were going to put it into Africa. So small business owners in Africa could have a way to run their business and improve their business. And the model behind a social venture is they're trying to make money and do good at the same time. Anyway, that's capitalization. Pretty easy stuff. It's just how you get money to fund your business. And let me know if this format works.